Welcome everybody. Just before I start, you've got the brochure and that's got everyone in there. So if you want to ask questions and you want to direct the name or you want to see who's up here in more detail, have a look at that. What we'll start today with is that we're in a multi-generational low interest rate environment which has got everyone perplexed. And the question from that is, how do we get a decent return and what kind of return should we get in that environment compared to the past? Wimal, I'll start with you. Obviously in the fixed income bond market, what return should you be looking for over the next 4 or 5 years given that backdrop?
Well, that's a tough question, isn't it? Because if you're a buy and hold investor, the returns across most asset classes are completely negligible. I mean, if you look at negative yields across 30% of government bond markets in the world, the buy and hold investor gets virtually nothing out of a lot of these markets. But if you're actively trading and positioning in these markets, I think you can still make decent returns, especially when central banks across the world are driving interest rates further negative, and that means you get decent capital return out of some bonds on a shorter term time horizon.
Okay, let's define decent.
I could see a situation where you could get 4 to 6%, somewhere along those lines, if you're actively trading. Now, given the fact you've got cash running at sub-zero in a lot of the world, those are decent returns.
So 4 to 6%?
Yeah, it depends on the level of leverage, but I think that would be a eminently achievable target. Yeah.
And before we leave your opening comments, where are you going to get that 4 to 6%? Which asset class in particular?
I think Australian bonds offer very good value, European bonds, and I think at some point Japanese bonds will as well, but you'll be looking at doing that from the short side.
That means rates keep going lower?
Yeah.
And for how long?
For a long time till they monetise debt. I assume we'll come back to that one later.
And that means other asset classes are tough in that environment?
I would have thought so. Yeah, I mean, the problem is that our belief is that we're in a slowing global environment, and that's the reason why they continue to pull the monetary lever and force interest rates lower, and that's generally not good for the other asset classes.
Okay, bring you in, Nikki. So you're sitting over almost $50 billion worth of funds, concentrating on equities around the globe. Correct me if I'm wrong, but I think Magellan looks for about a 9% return.
You are correct.
We take Wimal's comments. How do you achieve that? And is that a realistic target in this kind of environment compared to the past?
Yes, it's realistic. And why is it realistic? I guess it really is framed not from thinking about it as an asset class, but as looking within that asset class for opportunities that we can take high conviction bets on. So we're always trying to find those businesses where we see often the best opportunities are where you've got industry tailwinds. You've got industries that are going to grow much faster than world economies. And if you can get the winners in those industries and you buy them at the right price, you can ride them for a long time. So businesses like Visa and MasterCard have been fantastic businesses inside our portfolio. There's a very strong structural tailwind behind them, but they're also winners in the game. So we have a very concentrated portfolio inside of equities, and that's how we believe you can continue to achieve. If we can achieve 9% per annum compound, people will make a lot of money in this world. So that's our ambition, and it's absolutely how we set the rudders and the tillers and the sails as we try and take this portfolio forward.
So give us some parameters. You said industries that are growing quicker than the general economy. What should we look for in general economy? I mean, you can talk global and maybe come back to Australia.
It's a hard one to give you a specific on. I think you've got to break it down, I guess, regionally. Most people are looking at the US, continuing to run at low single digit. Europe maybe accelerating a little bit, but similarly low single digit real GDP growth numbers.
Yep.
But within that, of course, there's parts that go faster and parts that go slower. Asia's a mixed bag, but China, I guess, is the real question as to whether it can sustain the sort of rates it's been doing. I think most people expect it to decelerate, but continue to be reasonably robust compared to the rest of the world.
Okay, we'll come back to China, but what about Australia? What's your outlook there?
We don't invest much in Australia, so we kind of keep an eye on it, but I don't think I would be the right person on this panel to give you a specific view around China's growth outlook. There's a fair few moving parts, and China's a part of it. So
sure, well, we'll come back to China. Mark, you obviously look at a lot of portfolios around the world, how people structure them, and obviously you were the head of the Future Fund a few years back now. Somewhere like the Future Fund, about 130 billion of assets, a big chunk of assets. They set a target of cash rate plus 4% on returns. Today, a vehicle like that, like a lot of other managers, sitting on a pile of cash. They've got 25, 26% cash. Can you give us your views of what is an achievable outcome in terms of returns, and how would you structure that if you were, say, sitting in a future fund or another big fund at the moment?
Yeah, obviously I can't talk on behalf of the future fund now, but one of the last Senate estimates I did was to talk about low returns, so I have a view that the returns are going to be lower. But about a year ago I was asked to present at the OECD because they're worried about this topic, right? They're worried that people are going to overstretch for returns. And so I had the audience like this audience, and I said, I think returns are going to be about 6%. And you know when an audience doesn't like what you've just said, you can feel it? Maybe I'm feeling it now, right? And so then I go, oh, maybe 7. And then I go, oh, perhaps 8. Right? And half the audience relaxed. You could see them physically relax, which is kind of pleasing, although even 8's a high number.
And that's total return, that's not a real return.
That's a total return, and obviously it's a generalised question to a European audience. But the reason it's so critical is because if you've got too high a number, you'll chase returns that don't exist. You'll be tempted. And to be honest, the asset management business will be tempted to sell you that stuff. And so you've got to get that number right. I did this recently with a bunch of university students at Melbourne University. I asked them for the vote. And I did a vote, I did 2 lectures. And I did the mistake the first time. I asked them, we could do it here, but I won't. But I said 2, 3, people stuck their hands up. Of course, people are slow to stick their hand up. So the next lecture I did it randomly. What was interesting was it was around 6 or 7%. This is a bunch of students. But there's a large group of Chinese students and a bunch of hands went up at 12%. And one of the problems that China's got is that people want those returns, but even in our own market, people chase these returns. So my answer is get your return sites down. Get them down because we've seen great returns because we've had a one-off revaluation courtesy of 30 years of falling interest rates. And so that's bought forward valuations. Endowments, for example, today have this problem. They don't have enough yield, and yet they've had more capital growth than they realise. In other words, the capital growth has been compensation for the falling yield, if you see what I'm driving at. And so we've had this one-off boost. And so I can give you this little insight that at the Future Fund, when we were looking at long-dated assets, in 2012, 2013, you had to make a very big decision. And the decision was, is the discount rate going to stay low for a long period of time? Because if you bought airports at a lower discount rate, you'd be prepared to pay more for them. And it turns out that was a big decision to make. But you get a one-off revaluation during that process, and you appear to get 15 or 20% returns. After that, it'll go to lower. It'll go to 6s, 5s, 7s. So my answer to the question is it's got to be low. But if we get a shakeout in the markets, if we get a cyclical correction, then you might be able to pick up stuff that's cheap in a contrarian way, in which case you can get better returns, and maybe the Magellans of the world will drive that. So my answer is maybe 6, maybe 7s. Anyone happy? 8?
Then we're not going to let you off there, because going on Wimel's comments, that process isn't over. Rates are going to go longer. And if you go back, distinctly remember everyone reading about it, talking to people, don't expect great returns. Now, if I produced that 5 years later, I could have been in infrastructure, I could have been in the NASDAQ, I could have been in certain currencies, I could have been in the Sydney real estate market like most people here. Correct. And we'd laugh at your 5 or 6%. So why is it different now?
Yeah, it's a judgment call, and so you might disagree with me, but the point is that the discount rate has been falling for 30 years, and so there's a lot of habit behind this. We've all been very lucky to be an investor for the last 30 years, basically. And I would say that from, let's say, 8, 9, 7%, that next step down in discount rate in 2012-13 was reasonable. The trouble is now that if you discount it even further at these current low rates, it starts to be because there's going to be a recession or there's something wrong with the earnings side of the discount story. So there's 2 parts to valuing something. One is how much it's going to earn, and the other is the discount rate. If the earnings generally hold up, like Melbourne Airport, as I paid for the parking this morning, right? That's got great earnings profile. If the discount rate comes down, the valuation of that goes up. But if we continue to get discount rates falling from here on in, then I think we go into recessions, and some of these asset classes have leveraged earnings to them. We've already got the highest profit share in the world in many of the corporate sectors. And if we get rates down here or even further down, it's on that tipping point where it starts to affect the earnings. And the present value of no future earnings is not much value. It doesn't matter what discount rate you use. And so that's the balancing item. We've finally reached the point of discount rate falls where it's starting to affect, it'll go lower if our growth environment is much worse.
Okay, well that's your cue, because that's your belief. The rates are going lower. Does that mean we're at that tipping point, recession, global, regional? How do you see it in terms of economic growth?
Well, I think it's become accustomed and everyone believes in quantitative easing. So if you look through through the way this has played out in terms of slow growth environment since the GFC. I agree completely with Mark. We had a debt super cycle that ran up leverage, ran up borrowing, and then we saw lower interest rates and lower inflation, effectively from the early 80s all the way through to the GFC. Then we've seen slow growth. So they took interest rates to zero. Then we embarked on quantitative easing. Now, quantitative easing was great because it meant that we didn't have a depression-like event, but it's proved to be completely useless to get growth from 1 to 2 or 2 to 3. So if you look at IMF forecasts since the GFC, they always forecast growth to pick up, and every year we see growth lower. And now that we're through the end of quantitative easing, where the political will is no longer behind it, now we're moving into negative interest rates. And there's no question that the growth is coming in lower. It's beginning to worry people. And we just saw RB just a couple of weeks ago, you know, the Prime Minister of the third largest country in the world saying that there's a crisis. And then
Has he given up?
Well, I don't think he's given up yet, but they've got a massive bazooka to pull, which I assume they're going to pull soon. But the problem is that he was going around the world trying to argue for fiscal easing. Now, that's completely the right thing, because you can't rely on the monetary easing to continuously pump up the economies if you've got no fiscal response. But he got no traction with anyone around the world, and now that's where we're then heading into this position where they're going to need to monetize debt. Because interest rates have been coming down, debt has been built on top of debt continuously. We have too much debt in the world to handle higher interest rates, and we've got a demographic headwind against us. So at some point we need to wipe the slate clean, and we need to either default on that debt or we need to monetize the debt.
So explain the bazooka to us.
So the bazooka is debt monetization.
And how do we do that? Just
Well, Bernanke just wrote about it a couple of months ago. And for Bernanke to write a paper on debt monetization and not to be sanctioned by the Fed would be very unusual in our view. What Bernanke said is you create accounts at the Fed, put in, say, $500 billion, and then the US government just goes out and spends it.
Yep.
Or you take the debt that you have on the... So effectively, if you look at Japan, you have the MOF issuing the debt, you have the BOJ buying it, you can convert the debt into zero coupon perpetuals.
Yep.
And then it stays on balance sheet, you could write the debt down. But ultimately what you're doing is a massive, it's a fiscal stroke monetary response. It's largely a fiscal response. It's like, I mean, if you look back to the Depression, FDR introduced the New Deal in 33. The US was still in recession at 39. It was only when we got the fiscal spend around the Second World War that the US came out of recession. So fiscal spend is needed to start impacting growth levels higher. And we believe that fiscal response is going to be debt monetization, which means the currencies are devalued further, inflation starts picking up, and then you want to be, for example, in that situation, you want to be long the Nikkei and short the yen.
Okay, so that leads me on the next question.
I think monetization is where we have to go, because we've seen for the last nearly 10 years, all central banks in the world have tried to get inflation, get traction inflation. Inflation is going the wrong way, moving into disinflation and deflation across the globe. And so at some point with the debt levels we have to move into a monetization point. And it was always, this will happen in 5 to 10 years' time. But we don't believe that now. I think that Japan will move to a full monetization within the next 6 months. I think they've realized that they're rapidly running out of time and they have no other options.
All right, so what happens to currencies? You talked briefly about the yen then.
Yeah,
Can you give us a quick run around the currencies and then obviously our own currency where that fits into that structure?
I think the key point is it's US dollar against everything else. So I think you can be long the yen now up until that monetization, because the current account and the flows are definitely towards strengthening the yen. But the big story is about the US dollar. And the reason is because the amount of money, the dollars were pumped during the GFC, that flooded offshore, went into FDI in overseas, generally Asian economies, LATAM economies. The amount of borrowing was done in US dollars. The amount of dollar-denominated debt in overseas hands is very, very large. And so what happens is as their currencies depreciate, because a lot of money went into the Asian economies, they never sterilised the money on the way in. Therefore, it hit money supply, hit credit creation, GDP picked up, budget deficits looked better, they got upgraded by the ratings agency, and more money flowed in. So it was a big virtuous circle. Unfortunately, it's going in reverse. The money's flowing out. They never sterilise on the way in, they can't sterilise on the way out, which means their money supply falls, they go into a big black hole in terms of growth, and they have a decision to make. Do I cut interest rates to help growth, or do I hike interest rates to protect the currency? And that's the problem. And ultimately, you're getting a recession, whether it's a sharp, short recession or whether it's a long, drawn-out recession, you're getting a recession. And you can look across the emerging world, whether it be LATAM, Eastern Europe, or the Asian economies, and see that's just playing out in different ways, but it's playing out. So in terms of I think the currency, you want to be long the dollar against pretty much everything else.
US dollar?
US dollar against everything. And I think that's because the people who are buying it are not buying it for asset allocation reasons. They're buying it because they're forced buyers of dollars. And so it could go exponential. So I think you have a potential big upside in the dollar. We believe you could probably get, I mean, the dollar's moved, 35% since the lows in 2011. You could probably get another 20%. You want to definitely be short the yen. You want to, I mean, euros is a bit of a mixed bag, but you want to be short pretty much all the emerging market currencies.
The Aussie?
It's difficult. I mean, yes, we really like being short the Aussie, but that's not for the dollar story. It's because, you know, it's likely we lose our AAA rating sometime in the next few months, and we've got twin deficits. So the AAA rating helps a currency when you're running twin deficits. But if you don't have that AAA and you're running twin deficits, which are going the wrong way, and you enter into a world of capital flight, well, then the Aussie is not a good place to be.
We've been to 50% cents before against the US. Possible?
Possible, definitely possible. I mean, I'm very confident we'll go sub 60. We could go 50 very easily. And I don't think it will take too long to go there.
Okay, Nikki, we talked slightly about China before. Can we bring China into the equation? Because we're talking about Australia. China's been a big part of Australia's economic well-being for a decade or more now. Just some general views, because obviously you're concerned about where China comes because it's come off its growth peak and how it's managing that down and the outcomes. So some different variables that could come out of that.
I guess our view around where the world markets go and where valuations go is somewhat predicated on what happens in China. So the base case scenario that we're running is that China works its way through a transition over the next 5 to 10 years, growth slows down, but we get to a point where consumption's a bigger part of the economy, and we work our way through it with them managing using monetary and fiscal policy and keeping their hand on it. There's another scenario or two, but the other key one, I guess, that market worries about, and you see them worrying about it in times like January, February, is that they do lose control of it and that you get a very significant slowdown in Chinese growth. In fact, it goes potentially into a recession. And the big piece of that is really what's happening around the capital account and the renminbi. So if you saw a very significant shift in the renminbi, then I think it would be a very destabilising event, and you would have significant global deflation exported around the world, and market volatility would be horrible.
Works with what Wim was saying, that you hit lower rates.
It's not our base case, but it's a case that you have to be, you have to have somewhere on your probabilities list, because it's not something you can rule out.
And that's the definition of a hard landing in your eyes, because we always hear about China hard and soft. I always wonder whether we'll ever land.
Yes, yes, it's all a bit.
Because Japan never seemed
I'm with you on that, but I think it's a little bit to do with a hard landing, but it's also to do with market forces and people playing in renminbi markets and potentially destabilising it. And at the moment, the government's holding control of that market, but when there's speculators in markets around currencies, then it's difficult to call where it can go. Speculators can be very powerful in shifting currencies.
Okay, with a hard landing, a base, not your base case, but the hard landing.
Possibility, yeah.
Where you talked about industries that are growing quicker. Can you give us a bit of a snapshot of what you think can grow quicker over the next 5 years, and where we might be able to hide in an equity sense if we've got this doomsday kind of a situation?
Globally?
Globally, yep.
Yeah, so I guess the industries which we're watching closely are things that are being enabled by technology. And there are powerful shifts going on around the world related to technology that is changing at a perhaps ever accelerating pace. So things like mobility, the cloud, big data, even virtual reality starting to come onto people's radar screens. These are changing our world across so many places, and there are definitely companies that play to those changes and play to them in a very advantaged way. So we're constantly looking for those opportunities that technology presents to us as places where companies can actually be a part of that shift.
So not necessarily disruptors, but established industries that have got technology working for them.
Yeah, often, I guess from the way we invest, we tend to look at things that are established businesses that aren't priced into infinity. So, I mean, Facebook is a phenomenal company. We would love to own Facebook. That is absolutely built a network around its business, but you pay an enormous price for the potential future blue sky in Facebook, so we don't own it. But that's sort of almost a pure play. You back up to something like say an Apple or a Microsoft, which are much more established businesses, but inside those companies there is this embedded network effect that allows them to take their business and transition their business across to the new platforms that are emerging. So priced much more interestingly, but still got powerful growth momentum behind them. And so that's typically where we land in terms of the types of businesses that we actually can invest in and not feel like we could lose our shirt and blow up people's money. So
valuations are pretty key.
It's very important.
Okay, all right. Mark, just going back to, we mentioned cash before, and Wimmel's saying that, cash, well, we could see it overseas. We've seen Japanese go negative,
Right.
Parts of Europe negative, and so that is a totally defensive situation. It's about protection of capital. Cash, is it something good to be in at the moment? Because a lot of people, I'm sure everyone in the audience, has got some cash, because very few people have come back to the Aussie equity market, the retailers, and every fund manager I know is limit cash, and it's not always the best decision. Have you got a view on whether cash is a good investment over the next 3, 4, 5 years?
I think in difficult times or in any time, you should have a sort of rough process to the way you invest. And it's pretty simple, but you should be able to write it down. And even large professional investors sometimes don't do that. I'm working with somebody at the moment. I said, why don't you write down what you do? Because you're going to need it during periods of volatility. I did this recently with a bunch of students. We looked at the future fund and we looked at what they believe they should do, and we looked at their portfolio and we debated whether they're following their beliefs or not, and whether a high cash weighting makes sense for them as an investor. I don't know anyone's individual situation, but what I would say is diversification is still a powerful tool. You still need to have some element of diversification in your portfolio. Cash gives you that, and it's a question of the degree to which you want to move up or down in the cash rate. Mm-hmm. And so I think it's got a role to play, but it depends on your risk profile. But bonds also have that role to play, and I'm here for JCB bonds, but an active bond manager who can navigate through this environment, I think, is also an important component to a portfolio. Just on cash generally, if I could just broaden it out for 1 second on the monetary thing, I'm kind of shocked that central banks have gone negative on rates. And the reason I'm shocked by that is not because it's kind of the next step, but they're in the game of changing inflation expectations. And if every day you go to your bank and you get told that you've got negative rates, surely that compounds the thinking about negative rates, negative inflation, deflation. I think they should get to zero and then try some other tools. And the reason that's so important, and this is, Vimal mentioned this, is that we are now about to experiment with a change in demographics. I ran into Olive Rahn just before at the start of this. I don't know if you know Olive, but he's one of the great investors. And Olive did me a big favour. A, he employed me at Bankers Trust, and B, in my first 3 months, he asked me to do...
You can stop there. You're happy with that?
No, well, he's happy with that. But in the first 3 months, he asked me to do a study on demographics, which I've essentially used for the following 30 years. And I remember, roughly speaking, in 2010, the demographics would get relatively ugly for everybody. And the thing about demographics is, just to be absolutely clear about this, is that we've never in history run sophisticated economies with sophisticated financial systems through declining populations. It is a truly unique event. And just to give you a sense for that, the example I've given for a long time, and now people listen to it, is if you have 10 houses in the street and the population's growing as it is here in Australia, all houses get bid up. If you have 10 houses in the street and the population's declining and Mrs. Smith dies, her house is in perfect condition, what's the value of the other 9 houses now that Mrs. Smith has left and there's no one to buy it? It affects all asset prices in strange ways. And I think what they should be doing, and this is a policy view, is that they need to target policies to deal with what happens with poor demographics. For example, if you know your population is going to decline like it is in Germany and has been in Japan for a long period, and it is in South Korea and it's going to in many other places, you may have to fix the asset side of the balance sheet, as you said, monetize, for example. Now, I think Japan has pulled a trick here. They've monetized their government debt. Everyone says the debt's too high, but they've actually printed money and monetized it. Only the first person will get away with that. Other people down the track won't be able to pull it off. And so it's a lack of creative policy thinking about what to do about negative demographics, and it should not be underestimated. On the positive side, there are a few countries with great demographics: India, Indonesia, some Latin American. And I'd like to see the IMF focus on those guys and help them grow their economies, because they've got to be the powerhouse for the next period. And so it's a long answer to your question about cash, but it's a real policy question because we've never experimented before with such a tough demographic environment that can change the way asset prices behave. And just the last thing, that house example I gave, to try and colour the example, about 15, 20 years ago, I used the example of Tasmania that had a declining population, and I showed that the housing market was terrible. It was a terrible piece of analysis, but House prices don't work when demographics don't work, and our house price is partially going because our demographics are good, i.e. inflows, and I think that's an absolutely crucial thing to understand.
Okay, so Japanese vacancy rate's up around 15%. So somehow they need to destroy their housing market and reduce the supply, which would be interesting. Which is abandoning houses, pushing them down, and getting the supply back. So it's extreme. There's different policy measures to what we know.
It's an absolutely necessary set of policy changes because, and then there's some other things we need to do. Here's a question for you. If we looked at Japanese GDP and divided by the working population, in other words, how much GDP is being created by the people who actually work, has Japan outperformed America prior to the GFC and post the GFC, or is it underperformed? And the truth is Japan has outperformed. In other words, GDP per head of whoever's doing the work has gone not so badly. And yet here we are doing all these crazy policies in Japan, thinking that it's an absolute GDP story. We need to realise that it's a GDP per person story. And the flip side is, we think we're doing great in Australia, but given how many people we're throwing at the problem, are we actually growing as well as we should be? Is it good growth? Is it quality growth? And we're also attracting a lot of people to a high labour cost environment. So these are kind of more mature policy debates that we're just not having, that are absolutely critical to reset the levers to get good economic growth over the next 5 or 10 years.
Okay, so we've got about 3 minutes left before we go to the audience questions. Quick one from all of you. Worst fear at the moment with the macro environment. What can go wrong? How long have you got? You've got 60 seconds.
How do I put this? I can't see the upside here. So I can see lots of things potentially going wrong, but when I look at what could bail us out, massive quantitative easing packages across the world, but I'm not sure they would do that much. Spontaneous pickup in growth, which I don't expect. So everything I look at is telling me I need to be really concerned about the downside to both economies and markets.
You could have answered that in one word, everything.
Everything.
Nikki, same question. What worries you most that could go wrong in the next 6, 12 months that might disrupt your base case, as you put it?
Yeah, to be honest, nothing keeps us awake at night. We're positioned for kind of probabilities. But if there's one extraneous event which I guess could be very destabilising for markets, which I actually think would be quite good, would be China getting into a really deep hole and not finding their way through it. And while I think it's a very low probability event that China gets into a really bad GDP place, it's a possibility.
And that will have ramifications around the world for the exporting the deflation that you talked about and the slowing down of growth.
Yeah.
Okay. Mark?
There's been many positives in the last 30 years, but one of them has been globalisation and the emergence of cheap labour in the world. It's actually helped, and it's been very good for the cheap labour countries. If you do a plot that shows the number of people who earn salaries around the world and what their salary is, you get two normal distributions. You get the developing world and you get the developed world, and it's amazing. You never get normal distributions. If we'd all started together in the 1800s, we'd have one global labour market, but instead we've got two. The reason is because the people on the left, the emerging countries, only appeared in the last 30 years. They appeared and have tried to take share because they want to grow their economies, and they've largely taken it off people on the manufacturing end, the lower end of the developed world. The two curves, these guys have come this way in real terms, so they've had fantastic 10 or 12 years. The guys on this side have gone slightly backwards. The two curves naturally want to come together, but they're still a long way apart. And the problem is that the guys on the left are now beginning to upskill to take the middle class, the more skilled area of the developed world. Can we get the two curves to come together without a trade war? And I think Sanders and Trump are symptomatic of that danger. I don't know why we don't see the danger yet in Australia. I hope we don't. I never do. But there's no question that keeping everybody employed in a global labour market where pricing and excess supply is everywhere, and you've only got to ask university students how hard it is to get work at the moment, that dynamic is really important, because if we get policies in here that start to fiddle with markets or change policy environments or political fracturing, which seems inevitable in some countries, then we may get an excess risk premium and markets will do badly for a period of time.
I was going to say the greatest risk, we've got two elections going on, one in the US and one here. It took the third person to say they were worried about Sanders or Trump. No one mentioned Shorten or Turnbull, which is interesting, which is home base. So what we'll do now is we'll open it up to questions. Tom, have we got microphones going around? And so we've got about 15 minutes to any of the panel. I'll kick it off just while we're getting ready from online questions that came into us. And the first one is open to all the panel. I might get you, Wimmel, to answer. Just due to the scale of non-standard monetary policy intervention, so distorting market prices, and is there a inevitable unwind? So if we had prices pumped up too high, and we're going to end up with tears, blood on the street.
Yep, so if we address that quickly from two ways. Firstly, yes, we've got a lot of quantitative easing packages, a lot of money that's flowing around the system, so we have to step away from that in one way. We inflate it away, or we expressly default on it, or we monetize it away. So effectively you've got to get rid of that debt, and it's one of those three measures. We tried inflation, that doesn't work. Europe's tried some defaults, it's the third one, it's monetization that we're going to do. And secondly, on the asset price side, how does that one work? I completely agree with Mark. All we've done is brought forward asset class returns from the future to now. So quantitative easing packages, let's be clear, they do not increase productivity, they do not increase GDP, all they do is shift it through time periods. So we brought forward GDP from the future to now, so the future does look pretty rocky. And when you look at risk assets, which are priced on future earnings, again, they don't look great to me right now.
Okay.
So I came at it two ways, but I think both of them are concerning.
Right. So have we got questions in the audience? Just here. Gentleman in the middle at the front. And please direct it if it's to a specific person.
Okay, I've just got a quick question for you, Matthew. Are you as negative as your panel members, and what could disrupt your scenario?
Okay, so I'm not the subject here, but anyway, I'll give it a quick call. No, I'm not. I think that there's all the problems that Wimmel has suggested, but I think the key is a rebalancing, and I think we're going to keep grinding and grinding with lower growth. Productivity is going to remain low, but interest rates are going to remain very low for a long time, and it's a relative game on a global scale, which is the Japanese will not be able to lift rates in the next few decades, I wouldn't have thought, and Europe's not far behind it. That means other countries have got a relative interest rate where currencies will go too high if they lift them too high. I think as long as we don't go into a big recession, that means that equity prices will keep re-rating. And question is, if you've got zero interest rates, what's the right multiple on a stock price? No one's quite worked that out yet, but I think it's quite high, unless, of course, there's an economic problem. Sorry?
Your major thing that could throw everything in?
I think over the longer term, the biggest problem that we've got is longer term. It's a demographic problem, which Mark's just outlined. There are big changes in demographics around the world. It's already affecting productivity. There's very few economists talking about how it's already affecting workforce. They're concentrating on the over 70 or over 65s, the retirees, but it's already infiltrated the workforce. It's the major reason there's very little productivity growth in the world, and it's not changing. Demographic trends are long-term, hard to adjust, and places like Japan Japan's terminal if they don't change their policies. They're going to be a country of 80 million people in 2 or 3 generations' time. How you handle a shrinking population when we're used to economic growth and expansion is something that it's an experiment far greater than the monetary stimulus that we've experienced over the last 5 years.
Question. Any comments on gold?
Who wants to answer that? Yeah?
I'm happy to say gold. Yeah, I mean, we can sit here and debate whether it's a currency, we can sit here and debate whether it's a store of value, but it acts like a store of value, and you've seen gold respond to the increase in central banks' balance sheets. So I can completely understand why people buy it, but I'm not a big fan of physical gold, because I can understand why you'd buy financial gold, i.e. buy ETFs or gold futures, but if you start buying physical gold, I think the whole system needs to go down for that physical gold to have any money, and you don't need gold at that point. As I said to someone last week, you'll be fighting for grain in the streets before then, so physical gold won't do anything for you.
All right, next question. Gentleman here.
Question for Wimmel. With the monetisation of debt, I can't quite get my head around how you can just put a line through hundreds of billions or trillions of dollars of debt. I haven't read the Bernanke paper, by the way, but I can understand what Mark said, only the first person will get away with this. And it would have to, I would think, create really significant currency volatility. Once, say, Japan, I would assume, is the first person to do it, why wouldn't the ECB, the Fed, the Bank of England all try and do the same thing? And how can that not have really dramatic consequences?
I completely agree with you. I think it will, and I think that's why our view on China is that the China slowdown is out of China's hands. How China transitions this period, whether it's hard or slow, it doesn't matter for China because China has no influence on it because it's going to be forced upon them by Japan. So when Japan monetizes, we expect the currency to depreciate markedly, and that forces China into a really bad situation. And it was exactly the same as happened pre the Asian crisis, where you had Japan going first and China afterwards. The rest of Asians fight for competitiveness and then devalue as well, and slowing economies and the knock-on effects. So you fully expect Japan to go first, China to respond, the rest of Asians to respond. I mean, everyone talks about currency wars. We're in the midst of currency wars right now, and we're fighting over very weak growth and negative world trade. So that's the problem. There's not enough growth to go around. When you look at countries which have gone through banking crises in the past, they've managed to get out of them because the world's been growing around them. This isn't the case now. And so it's just a case of currency wars which get worse and worse and worse. And that's how we see it. At some point, I would expect inflation to rear its ugly head. And I don't think that's far away as well. And then that will be pretty ugly when that happens.
There's a question up here. I've got one maybe while the gentleman up here on the aisle. I just got one quickly that maybe Nikki can answer. Last time the US, when they eased back on their monetary stimulus, we had a temper tantrum, or a taper tantrum, I should say. And now we're in interest rate rising mode in the US. Do we get another rate rise tantrum? Do the market's that volatile and that juvenile?
I honestly don't know what the market will do in the next few months, and I don't think anyone honestly does either. So, it's a guess as to how markets may respond, but everybody's expecting another rate rise and we're talking about a cash rate rise. It's not really that's the issue, as far as I can see. It's more around where's the actual whole curve go, and can they continue to grow if the Fed's putting rates up, or is this going to create instability?
And your base case is that they do keep putting up rates gently over a period.
Yeah.
So how does that play out? Do equities have to adjust on those valuations?
I think you'll see volatility, absolutely, and so equities will respond. But if they're doing it because they're getting economic growth and you're starting to see inflation in the US, then the economic backdrop will actually be quite positive. So you just got to be positioned in the right way, and being long the US dollar and positioned against the right assets is probably going to take you through it.
There's a way through that.
Do you mind if I jump in there?
No, you're right.
I agree. I think the Fed will have to hike rates, but the problem is the US is late cycle now. So, remember, we've not seen a proper turn down in growth since 2001, and that was back .com. So when you get late cycle in the US, productivity turns down, unit labour costs turn up, profit margins turn down, people try and pass those profits on in increased inflation or stop hiring workers, and so you get inflation spikes at the end as the US is slowing, and that's where we are right now. So the US has a building inflation problem right as the economy is slowing, and the Fed's in a real bad situation because they're being forced by the market to hike rates, which will push the dollar up and slow the rest of the world around and increase volatility. So we've got a really bad situation, but one thing that's going to happen is the dollar's going to go up, the US dollar.
Okay, the gentleman up on there he is.
My question is for the panel. What does the panel think the chances of the Brexit proceeding, and if it does, and the UK does leave the European Union, what is the global impact on the global economy?
Mark, we'll handball to you first.
Yeah, look, I don't think they will. I'm going out to the UK tonight actually to test the waters out there for what it's worth, but I don't think they will. But what happens if they did? People are fragile at the moment, and when I present to audiences, there's also lots of questions at the end in Australia. People are kind of anxious, and they're anxious all over the place. And so signs of anxiety makes people more anxious. Someone said before about the panel being negative. I'm actually reasonably optimistic we'll navigate through this, but I do think you need diversification for the benefits of getting through these dangers. But if people were to leave the Brexit, it raises a lot of questions about commitment to broader community issues. I think Trump raises those questions, Sanders raises them. We've had a terrific 30 years where everyone sort of was roughly on board together. I think China's going through a maturing process in terms of where it sees itself relative to everything else in the world. And so I don't think Brexit will happen, but the question is, are we all in the boat together and how do we respond together? I'm hopeful that we're going to be able to navigate it, but we've really had a terrific 20 or 30 years. We've had, I'll give you an example, something that most people don't realise. We've had the lowest violence in the world in history in the last 30 years. It doesn't feel like it because you watch the news every night and there's lots of violence. But the fact is we haven't had a lot of wars. It's been a really good environment. But it's being tested. People aren't sure. And it's all got to do with essentially their perception of themselves, their personal situations. And this is where great leadership is going to be really important. And we need leadership now because we don't want politics to fracture too much. And this will be the test. But the Brexit, I don't think it'll happen, but it is symptomatic of the breaking away. And if it did happen, we could get ricochet effects all over the place. There'll be certainly lots of volatility.
Nick, you got a view on Brexit?
That was very deep.
It was.
Getting a little less deep, I can only tell you what the polls say, and the polls say it's probably unlikely at this point. Does it matter? No, it doesn't matter. It'll matter a little bit for Britain, but for global economies, no, it doesn't matter. Focus on something that matters, and that doesn't matter.
Can we get a positive comment out of you?
Oh, I think it matters greatly. I just think that if the UK goes, well, then Europe will break up. I think there's no way out. You look at the Economist poll just the other day. I mean, everyone wants a referendum if the UK breaks, and then Italy, Sweden. There's so many different countries who would want to vote to leave. So I think it brings the whole European experiment into question, and that's a massive big deal for us. I mean, personally, I think they should go. I don't want the EU telling me how wonky my banana should be.
Yeah. So you want the disaster scenario, but...
well, it's good for bonds, isn't it?
Yeah, exactly. Exactly. Any other questions? Is there any... there's a man up here. Yep, thank you.
Can India in any way replace China as the growth engine?
Mark, do you want to have a shot at that?
Yeah, it's a really good question. India's demographics are fantastic, absolutely fantastic. And we'd hope for that to be the growth story. And I don't know if you've ever been to India, but when you go to India, you get this fantastic optimism. At least you sort of feel like the place is going to be brilliant. But if you've ever tried to do business, it's kind of tough. The last 5% of a deal takes forever, or whatever it might be. On the other hand, there are great non-resident Indians who build fantastic businesses all over the world. So you've got all this kind of mixed dynamic. I'm hoping that India will be a growth engine, but it doesn't seem to have the alignment of growth that, say, China has. China, by the same token, I think I'm kind of optimistic because it's a naturally entrepreneurial economy, like aggressively entrepreneurial economy, but it's trying to control itself and smooth itself out, and it hasn't experienced how to allocate capital properly, in all honesty. So India's got some possibilities. I think it'll grow well above average. It'll have some interesting stories, but it doesn't seem to have the cohesion that could drive a true growth story as perhaps China did in the last 30 years. That would be my take.
Anyone else?
Yeah, I think.
We've got the bell lap there. This is the last question.
My only point to that would be that I think if you're asking if India can replace China, what you're really asking is that can India create a new super cycle in commodities, which is what China actually did. And to cut to the chase, not in this next decade. It's just too small. So they are doing some great stuff. Modi's absolutely the right guy. If he can stay in power for 10 years, India may actually make progress politically and economically that would get them into the place where they will continue to grow very strongly. But it's just tiny on the world stage as an economy, and so it's just not, it's a false hope if you've got a hope pinned on India.
And then just on, India's main issue is reform, and they desperately need lots of it. But as they always say in India, it's all about what's that comment? It's all in India. Sorry, I've lost the comment. It was
all about the afterlife. Or?
No. It's funny you should mention that. No. In India, after all is said and done, more is said than done. So.
It's hard to remember.
Yeah.
Okay, I'd like to thank Mark, Nikki and Wimmel for being on the panel today, and we really enjoyed your comments. Thank you very much. A round of applause. Thanks a lot.